You are listening to KeyStone Stock Talk Show, episode 313. It's great to chat with you again this week. I kick off the festivities with an update answering a viewer question on Aritzia Inc., symbol ATZ on the TSX, a rapidly growing fashion retailer which has now gained over 400% since our original recommendation. Brennan updates a viewer on Fluence Energy Inc., symbol FLNC on the NASDAQ, which delivers intelligent energy storage and optimization software for renewables and storage. Brennan reviewed it as a dog back in February and revisits it after a recent rally. Is the move justifiable? He will let you know. Brett takes a look at leveraged ETFs, one of the latest financial products being increasingly pushed to retail investors as they offer 2 times to 3 times the daily returns of their benchmark assets. Brett lets you know what they are and if they should earn a place in the average investor's portfolio. All right, let's get to the show. I welcome my co-host, both the killer bees today. We've got Brett and Brennan.
Yep.
We got
Brett's
Brett back from the depths of a sickness that took him down for at least a week.
Have a voice again.
It's nice to hear. Or is it? I don't know. We'll see. And Brennan sounds sick today, but he is definitely recovering, right?
Yeah, I mean, I'm normal, kind of. It's just
Again,
working its way out of my system still.
It's the
just,
milkshakes,
it's just hanging
guys. Quit
on.
sharing
you know?
them.
We just love you so much.
What's happening?
Yes,
I just see you guys. Milkshake to milkshake, cheek to cheek.
But yeah,
all right, that's enough.
Happy Thanksgiving as well.
Yes, belated.
Belated. Yes.
Did you get into a turkey or?
Yep. Turkey, ham. I'm more of a ham guy personally. You're
a bit of a ham, let's be honest.
It was funny. My girlfriend's dad, he had, there was lobster mac and cheese. There was everything out there, and he kind of second looks at the table and he's like, "We don't have any greens." and I was like, "Don't worry about it. Don't worry about the greens.
Brussels
Let's just
sprouts,
get into it."
Brussels.
Yeah, there was none of that. At my parents, they had some corn and peas. I know that listeners want to hear about that so much.
Yeah, please talk about them. You mentioned you have a girlfriend. Most of the listeners don't believe it, but it's good to hear.
I think the listeners believe it. I just don't think that you believe it.
Again, proof of concept. She needs to come and visit.
Yeah, maybe she'll be at the Outlook. We'll see.
Yeah, we'll see. Well, speaking of conferences, myself and Brett will be at the Planet Microcap event with the Microcap Club in Toronto next week, interviewing a number of companies at that event. I'm looking at the list now. There's a ton of companies on there. I know we'll be talking to BioRem. We'll talk to Covalon, David's Tea, potentially Dirt, although we just talked to them a couple weeks ago. Firan, iFabric, among a huge set of names that are at this event. Namsys we may talk to, although we just interviewed that company, I think last week. So yeah, I mean, there's a bunch of. Brennan is excited that Playboy is there. So
no,
thank you.
I'm
Brennan,
excited
for that.
to hear back just how the David's Tea interview goes. We ended up interviewing the investor relations just a week ago, and the call went well.
You've been on a tea binge ever since, right?
I mean, while I was sick, I was definitely on a tea binge. But as we were discussing in the office, where do you buy your tea? I just buy my tea from Sobeys, but there's definitely some brand recognition with David's Tea for sure.
Right. Sobeys isn't even sponsoring this, for God's sakes. We need to get
Sorry, we'll have to bleep it out when I say their name.
Because of Safeway sponsoring us, right?
Yes.
And they'll be pissed at you.
But yeah, I'm interested to see, just what management says kind of on the growth strategy, because we did get kind of an indication on what the growth strategy is from IR. But
good to talk to the intellectual team behind it, right? I think we'll talk to the CEO there and the CFO. So
and comment below if you want that to be an upcoming segment on the podcast.
Yeah, for sure.
Brett will do it. Not
interviewing them or a segment on them. You can ask a question
about
them.
How. Yes, or if there's questions.
How Brennan likes tea.
Yes.
Good. No, it should be an interesting event, and there's about 80, 90 companies there. We should do by the end probably 15 plus interviews, so should be good. And potentially, we know there are some companies there that are in coverage. Versa Bank's there, and we'll sit down with management once again. So it should be again a good event. We look forward to it. We look forward to anybody who's out in the Toronto area. Come say hi if you're near where is it at the Arconia or something, Arconia Lofts, or I don't know if I'm pronouncing that correctly. It just comes to my head, but the Arconia. So we should be around there. Should be amazing. All right, should we get to the show? We don't have a poll question this week. Do we want to discuss anything, or did we just do that?
I mean, I think that we just did that realistically. I mean, obviously the markets have been quite volatile here with Trump's comments after China was looking to restrict that guy, that President Trump guy. After China was looking to restrict its rare earth metals coming out of the country. Now he's kind of walked it back and said everything will be fine. So we're seeing the market rebound, but we're still going to see. It's going to be interesting to see what just general tariffs are going to be bringing. Over the next few quarters, and just finally when it actually really hits into the numbers, we might have seen.
Yeah, there's certainly a lag, and that's what we're kind of looking to see if there is more of an effect as we get into the quarterly numbers over the next maybe 3 to 6 months.
Mm-hmm. I also, this is just kind of a tangent a little bit, but on that day, crypto had a significant loss, and I was watching a lot of videos on YouTube. So take this with a grain of salt, but they were saying a lot of it is due to elevated margin, just kind of with Bitcoin traders, so that kind of led to a little bit of panic selling because of the margin that's out there. Again, I can't confirm that. I'm just
I believe it was the single biggest, not on a percentage basis, but on an absolute basis, loss for Bitcoin in a day. So just massive. I think it was some ridiculous amount. I think it was 20 billion or something. I would have to look the number up to get the exact figure, but that's what I'm remembering. Yeah, but again, it was an absurd amount of money lost overnight.
And we just caution kind of listeners, we are seeing, high valuations historically, relatively speaking, high valuations across the market. Not talking about crypto. I'm just talking about just general equities at the higher end of their valuation, historically speaking. Mm-hmm. All right. Let's get to our first Your Stock, our take. We're going to look at Aritzia, a company that we recommended originally to clients around 6 years ago now. Company trades at around $86. Then it traded around the $16 range, so up 400+%. It was founded in 1984 by the Hill family, including founder and executive chair Brian Hill, a third-generation retailer. It's a rapidly growing, innovative design house and fashion retailer of exclusive brands targeted primarily towards women aged 15 to 45 and Brennan. Aritzia is a strong niche player in a fragmented industry that differentiates itself through an integrated model encompassing conception, creation, distribution, and direct-to-consumer retailing. The company is positioned between affordable luxury and fast fashion, and its loyal customer base cites the design quality of the fabrics and construction of Aritzia's offerings as key differentiators. We like the growth as a differentiator and the growth in both revenues and earnings. But let's look at what makes this company a star over the past 6 months. If we look, the stock is up 102% over the past 6 months. You juxtapose that to where the biggest name in Canadian women's fashion, that would be, and it's not just women's fashion, but one of the iconic names, Lululemon, it over the same period is down almost 35%. We also like to highlight, because there are two names that we have recommended in the fashion industry in the Canadian markets. The only thing that has been stronger than Aritzia over that period. Over the past 6 months is Group Dynamite, up 455% over the past 6 months. Now, a company again that we recommended earlier this year in the below this $18, $16, $12 range. It got down to $10 even before it started really surging. Okay, so and this is just Aritzia over the past 5 years, so significant outperformance over that time, great growth in the underlying business. But what is driving that? Well, let's look at the growth in the last quarter. This is the Q2 fiscal year 2025 numbers. Net revenue increased around 32% with comparable or same store sales growth of 21.6. That is a very high number. U.S. revenues, net revenues were up 40.7%. Net retail revenues were up 34.3%, and e-commerce were up 26.5%. That accounts for around just under 30% of net revenue. Gross profit margin increased 360 basis points to 43.8. Adjusted EBITDA increased 122.5%. And adjusted EBITDA as a percentage of net revenue, we saw a real kicker, up 610 basis points to 15.1% from 9%. Net income increased 263%, and net income per share was up 250% from around 16 cents in Q2 of 2025 or fiscal 2025 to 56 cents in this past quarter. And adjusted net income was up 184% on a per share basis, up from 21 cents to 59 cents per share. Let's look at the balance sheet, the liquidity position of the company. It generates solid free cash flow. They're self-funding their rapid growth in revenues and operating income with a clean balance sheet. Adjusted net debt to the next 12 months projected EBITDA is below 1 times. The leverage largely capitalized leases here. Let's look at the guidance going forward. It has quite a bit of detailed guidance, which is nice for us analysts. Q3 2026 outlook reflects strong top-line momentum from Q2 continuing into Q3. Revenues are expected to be up around 20 to 24%, revised from around 23%. Gross profit expected to be relatively flat, last published at 70 basis points plus revised to around 23 basis points, so a little bit of a slow there. SG&A as a percentage of revenues expected to be flat. That is a revised flat there. Now I'm going to look at the fiscal 2026 revenue guidance that's revised upward to reflect the strong first half of this fiscal year. Revenue here up around 21 to 22%. That is revised slightly higher. Store openings to around 13. Previously, they were looking for a minimum of plus 12, so they're there. New boutiques 4, repositioned was previously 5. Adjusted EBITDA margin of 15.5 to 16.5%, which is unchanged. And CapEx is up around 20 million to 200 million. Now let's look at the guidance for fiscal year 2026. EBITDA margin guidance moderated from the target of 19% to a high teens figure. Analyst consensus was last published around 18%. Revised forecast is essentially unchanged going forward from the analysts. On the conference call, the CFO did note that 19% is still a possibility. They are just being cautious in the near term. There is a little bit of weakness in the end markets. So let's look at valuations. This is an adjusted forward-looking 2026 expected PE. And this is 2027 actually there. So it's 32.6. 2027 expected is 24.4. My quick conclusion here, the Q2 results were very strong in terms of revenue, margin, and EPS growth. It's fairly valued in the near term. We have a hold on the company. It's done tremendously well. We expect, again, a strong second half to this year, but there is some moderation in terms of the growth of the business. The consumer is stretched to a degree. And there are our disclosures.
Yeah, consumers have been stretched a little bit to a degree, but like looking in the U.S., retail sales have still been quite strong despite tariffs. This is Bloomberg Money Minute.
Yeah, there's
I'm reading
price
here.
increases too, but yeah, good.
Retail sales were still rising in August, rounding out 3 months of resilient spending. Then, if I fast forward in this video here, they talk about wealthy consumers are driving consumer spending. A recent analysis by Moody's indicates wealthy consumers account for a large share of consumer spending. Consumers in the accounted, or the larger consumers accounted for, consumers in the top 10% accounted for 49.2% of total spending in the second quarter, up from the first quarter. So we are seeing, those wealthier consumers driving consumer spending as well. But just generally, we are seeing some weakness. I feel it in my pocketbook a little bit. I went grocery shopping yesterday, and I loaded up my fridge afterwards, and I was like, geez, I just spent $300 and didn't get too much. Maybe that's because I should, rather than just buying 6 tubs of protein powder, should actually buy some greens.
Just salad, Brennan. Damn it.
At least I cracked you up there. Obviously,
yeah. Well, it shows you. It is there's tremendous growth if you have the right mix in terms of products. If you don't, you're getting killed. Lululemon hasn't had. They've stated they've missed the mark on trends and their product mix, and they've been killed. 2 companies that have been hitting it out of the park in terms of Group Dynamite and Aritzia, and you see tremendous growth there. Same store sales growth is tremendous in those companies, and that's driving these share prices significantly higher. We would be cautious, in the near term, after you've seen strong runs in these companies, great businesses that are executing well right now. The sector is volatile. If you look back over the past 5-6 years, Aritzia did not go up in a straight line. It is, very volatile over that period. We'd expect the same thing for Group Dynamite. But, we were able to buy Group Dynamite earlier this year at under 12 times earnings. The same store sales growth in the last quarter was over 28%. So tremendous discount at that time, and great balance sheet. We like businesses, if you're in this sector, to have a good balance sheet, and it did as well. So these are the anomalies, if you're monitoring the market on a daily, weekly basis, that you can find. And if there's a depressed state in terms of those share prices, they're underfollowed. Group Dynamite was basically unknown in the Canadian markets earlier this year. Now you're starting to see it talked about all over BNN and the financial networks, but it was an opportunity certainly earlier this year. Now, much of that is priced in the near term.
Yeah, Group Dynamite really was, and this just shows when you are looking at these companies, you want to find those good companies before a market downturn, what can actually last. And that's what we did in this case. We were looking at it since effectively it IPO'd last November. But then we were really just, clients were coming to us, what can I buy during the tariff tantrum, that April period when the stock market got hammered? Group Dynamite was near the top, if not the top of the list, for effectively every client who did not already have a position. We were hammering the table, like Ryan was saying, because it was a good company, and it still is a good company, but it was trading at a ridiculously low multiple on some of those days. Like at the very bottom, it was, I think it might have just crept under a 10 PE even.
Yeah, I think it did. Yeah, I think definitely so. I mean, especially on a forward-looking basis, and now what it's been able to achieve. But even on a trailing, right, it was it was in that range. And you'd love to be able to find those companies. You need winners in your portfolio, and Group Dynamite, again, it's another company that's changed some client portfolios this year. It's great to see. That's what we're trying to bring to the table through that analysis. And again, great to see that from Group Dynamite.
Can I add one more thing into, like, this is just kind of anecdotal, but I was reading as well, just the Best Buy CEO essentially in the conference call talking about how consumers are looking for value right now out there. And when we're looking at like a company like Lululemon or maybe Canada Goose, these are premium products. Don't get me wrong. I love Lululemon. But when we're looking at, Aritzia or something along the lines of, or Group
Especially
Dynamite,
Group Dynamite. Yeah.
you know, it is more value for what you're getting compared to these premium or more premium products. So, again, that's anecdotal. This is just one, CEO's comment out there, but it's something to keep an eye on and watch, going forward as well.
I mean, not that we really know the trend. Not like we're sitting there on trend, but we're following the cash flows that leads us to being in the businesses that are on trend, because they have to be making money. But, it looks like Group Dynamite right now in their garage stores has a good mix of being closely on trend and then a relatively reasonable, not the lowest end of the price, not the highest end. So in a nice area right now where they were able to increase prices and people could still afford it despite the tariff situations, and margins increased in a time where a lot of people thought they were going to decrease. So interesting how that's played out. We'll continue to monitor the company going forward. Let's shift gears to a kind of an update, but Brennan, you're gonna get back to a viewer that talked about Fluence Energy. You talked about them in Your Stock Our Take, or was it a dog? Sorry, it was a dog earlier this year.
Yes, exactly. It was a dog.
Nice photo.
That I covered it. Yes, thank you. But yeah, and this is a company, I wrote a monitor report on it. We did a dog on it after, the company came reduced guidance. But yeah, so to go over it, it can kind of be like a Your Stock Our Take as well as a star. So it is Fluence Energy, a stock which, again, I covered as a dog back in February of 2025 when it was down 50% in one day after the company had lowered its fiscal year 2025 guidance. And recently, we had an individual comment on the YouTube segment indicating that the business has recovered from its lows, now up 30% in the past 5 trading days and up over 400% in the past 6 months. Again, keep in mind, these are from depressed levels after the stock dropped. But let's dig into the stock a little here and see if the recovery is justified and what is driving it. So Fluence Energy, FLNC on the NASDAQ, currently trading at a price of about $19.36, about a $2.5 billion market cap. They do not pay a dividend, and they deliver intelligent energy storage and optimization software for renewables and storage. The company's solutions and operational services are helping to create a more resilient grid and helping unlock the full potential of renewable portfolios. And Fluence Energy was formed in 2017 as a joint venture between two massive global energy companies, power producer AES on the New York Stock Exchange, and German energy equipment giant Siemens AG, SIEGY on the OTC. And here is just a visual representation of when we looked at the stock. I initially wrote a monitor report in July of 2023 for clients, indicating to clients that it's a name to place on their watch list as we track the company's progress toward profitability. And then I reviewed the company again after it was cut in half following the company's downward revision to fiscal year 2025 guidance in February of this year. And we have now seen the stock have a bit of a dead cat bounce or recovery from its lows. So looking at the Q3 2025 results, which were reported in August and are for the period ended June 30th, 2025, revenue was up about 25% year over year, primarily due to revenue timing weighted to the second half of 2025 compared to the revenue distribution seen in full year 2024. So, it is a little bit contract driven. You can see it be a little lumpy. As well, the company signed approximately $509 million in Q3, bringing the backlog, or how I have it here, consolidated performance obligations. So bringing the backlog as at June 30th, 2025 to $4.9 billion, which is up about 9% year over year. So that backlog does remain healthy. So looking at the top line here, we are seeing a sequential improvement compared to the beginning of fiscal year 2025, and backlog remains strong. As well, just looking over at the balance sheet here, it remains healthy. They did do a convertible debenture offering over the last year, or maybe over the last year, essentially. So the balance sheet has taken on a bit more debt since we looked at it last, but it still remains in a net cash position with 53 cents per share. And I also believe this is just kind of another note that the business executed a new supply chain financing facility in August. So that was subsequent to the quarter end here. So we may see the company dip into a net debt position in the coming quarters if they do not improve their cash flow. And they start to utilize that facility. Looking at the profitability, adjusted EBITDA was $27.4 million, up 76% year over year. Net income attributable to Fluence was $6.2 million or 5 cents per share, up substantially from $800,000 or 1 cent per share in Q3 of 2024. Cash flow was also significantly negative in the quarter, as you can see there on the yellow line. So, essentially, we can see here that that sequentially, margins have been improving to some degree and are getting back to in line to where they were in fiscal year 2024. But the beginning of the year was a little rough. Now, as I went over in my dog segment on the company back in February of 2025, the company then lowered its total revenue guidance range to $3.4 billion from its initial guidance of $3.6 to $4.4 billion, which was about a midpoint of $4 billion. And management said that the $600 million reduction in revenue from the previous midpoint was primarily due to the timing of certain contracts in Australia that the company now expects to sign later in the year. And they also lowered its fiscal year 2025 adjusted EBITDA guidance range to a midpoint of $85 million from its prior guidance of $160 to $200 million, which was a midpoint of $180 million. So we also saw, a significant decline there. Now, looking at the most recent update to guidance, management now expects revenue to be in the range of 2.6 to 2.8 billion, which is flat year over year, as they did about 2.7 billion in fiscal year 2024. And adjusted EBITDA is expected to be in the range now of break even to 20 million for the year, which is down significantly from the 78 million achieved in 2024 and down substantially from their, initial guidance at the beginning of the year when they were looking at 160 to 200 million. Then they revised it to 85 million at a midpoint. Now, we're looking at basically break even to 20 million for the year. Management also said on the conference call, despite the macro headwinds that have occurred this year, such as tariffs and legislative uncertainty, we have continued to take necessary steps to manage the business for profitability and cash flow, and this is reflected in their results. Now, quickly looking at the valuations, they all remain very expensive. Cash flow and net income remain negative over the last 12 months. So those ratios, really meaningless when they're negative there. And looking forward, the business trades at about 243 times enterprise value to EBITDA. So very, very pricey here after the recent move up in the share price. Fluence has remained on our monitor list as it is an intriguing business in the battery and energy optimization space with a strong balance sheet and growing backlog. The stock has performed well as of recent due to the better sequential results from the beginning of the year. Fiscal year 2025 guidance and the fiscal year 2025 results are still expected to be weak, and management will provide updated guidance when they release their Q4 2025 in November. So we can look forward to that. And while the results have been improving to some degree, the valuations remain extremely high. I would continue to monitor the business at this time. Again, I like the space that it operates in, but still very, very early and very, very expensive. And we do not. Here's the disclosure.
Yeah, it's a good summary. Really good growth, but historically, but high valuations.
Yep.
You're not building any margin of safety in with an investment in this company now.
Exactly.
Yeah, you're speculating on future revenue growth continuing to drive higher and then better margins over time so you can have higher cash flow. We just prefer to there are businesses that grow at a similar rate that you can find at a more reasonable price. And that's what we're looking for. I mean, we talked about one earlier this year, right? Like we looked at those two businesses, and they're in no way comparable in any way, but we looked at them at the start of this year. Right? One was for a podcast, one was for an actual investment, but we run the numbers on them. One is trading at a reasonable multiple, has a good growth path ahead of it, better debt situation likely, and one is a recommendation, one is something we're just monitoring, and you can see the difference in the returns in those companies over the course of this year.
And here's the thing too, is, if somebody wanted, like, I'm super interested in like this energy battery storage space. We have another recommendation that's currently a buy right now that is, focused in, they've got a few very interesting projects for battery storage. So this is an interesting business.
Yeah, and it's paying a 6% yield, and has yield. Likely, trading at 6 times cash flow, has growth going forward, likely built in this year.
There's a
and
case
could increase its dividend.
Exactly. There's a case to be made for investment where, like Ryan said, this is just with Fluence right now. It's just, maybe if you're looking 20 years out, or maybe not that long, but 10 years out, and management can execute.
And the growth has even slowed in the last couple of years. Right?
It has.
If you go back to 2019, 2020, 2021, 2022, and it started to slow into 2023 and grew again in 2024, but now it's come off of the trailing 12 months. So, you need growth to continue. You need margins to continue to go higher. And there's been a slowdown in growth, and you're trading at premium valuations.
I was going to say, I think the valuation has just been really driven by, you have really two factors. You have AES being potentially acquired by BlackRock. So the majority, one of the founders of Fluence is likely getting taken over by BlackRock. At least it could happen, very likely. Whether it closes or not, who knows. And then secondly, just the AI side of it is there's more AI interest in these battery storage solutions. So is that going to amount to something or not? Like Brennan was saying, it's 5 years down the line probably to actually be commercially viable en masse. But you are starting to see some of those factors from the theme of the last 2 years coming into Fluence more and more. So is it just purely a stock price change? Like, that's what I'm seeing personally. I don't know if you had any.
I agree. Like, even in our chat sessions, with clients, we get a lot of, how can I partake in this theme? And, even to the point of bringing forward, nat gas companies. Hey, is this company going to benefit from AI? Essentially, and like the energy demand from AI. So, I can definitely see that theme is so popular right now. And certainly, I would agree, bidding up the valuation and price on Fluence here.
So the right answer in these cases is companies that we bought a couple of years ago, for example, that were already positioned for not necessarily AI, but now they're benefiting from it, but they're highly profitable, have the good solid balance sheets. Now you're starting to be behind the 8 ball. People are searching, people are reaching. This is when you can get into trouble. And, we just, 18 months ago, 16 months ago, we were able to buy a company, Argan Inc., right? That then traded with a massive percent of its market cap in cash. And they're helping power some of the data centers, right? And it's like the stock was $48 then, it's $300 today. That was your growth situation. That is your portfolio changing situation. Now you're looking at companies, that are trading at valuations where everything has to go perfectly going forward. There'll probably be another opportunity in the next year to buy companies at a more reasonable price that have participation, that have exposure to that segment. But, we're not seeing much with value that you can buy right now to give you exposure. And there's a lot of companies out there that are not going to do well. Not that they're terrible businesses. There are some terrible businesses that are not going to do well, but there are companies out there that maybe are a decent business, but are trading like Fluence, may be a decent business, but it's trading at such a premium valuation. Everything has to go right. And you don't want 20 stocks in your portfolio where everything has to go right for this company to just justify its current valuations. All right. Should we move on to Brett's final segment here? He's going to look at leveraged ETFs. We get questions about these almost on a weekly basis in our chat sessions and just via emails, and average investors talking about them via our Your Stock Our Take or our podcast communications. So Brett's going to tell you what they are and whether or not potentially they are a good fit for the average retail investor.
Yeah, so like Ryan was saying, and it's not even just from our clients. These couple of advertisements I have up were just ones that I personally got delivered on Reddit, and I've been seeing them elsewhere as well. More and more of these leveraged ETFs and just more generally structured products. So you'll see those covered call ETFs and enhanced returns where they combine actually both covered call structure over a leveraged. Normally it'll be like 1.25, 1.5 times. So you're getting these more complex products in an ETF form, and they are more complex than what they can be on the surface. So you'll see here just right front and center, 3x daily leverage. You can really get that promise of 3x returns. Daily is very key to this, and even though most people who are going to be getting at the advertisement might not understand why that daily wording is so key, I've been seeing a bit better, because I have been following these for a few years now, a bit better disclosure on some of these ETF websites, but they're still not perfect. They still want your money at the end of the day. So let's really look into these. They've been just advertised to the masses like insanity at this time, like you can see with the ads here. And despite having these unique risks, they aren't, and seemingly straightforward structure, they aren't actually straightforward. They do have complexity to them. They offer normally 2x, 3x, and inverse variations, so short variations, so a negative 2x and a negative 3x. And the big benefit of these leveraged ETFs is just easy access to leverage instead of playing with options, futures, and margin loans. It's just a much simpler, easy thing. You can buy it and trade it like a normal stock. And that is the selling point to them. Bundled in a nice and packaged up easy scenario. You don't have to manage your leverage. You don't have to manage your loans. You don't have to manage the future margin. It is just so much easier. And that is really the big upside of these. So if you don't know what a leveraged ETF, or really familiar with leveraged products in general, if the leveraged ETF is tracking the S&P 500 index and that returns 2%, a 3x leveraged ETF returns 6%. If the S&P 500 loses 2%, the 3x ETF loses 6%. Nice and simple leverage. Further, if you want to short the S&P 500, there are nice and easy inverse ETFs, eliminating the need to manage a short position, which can be appealing, especially for some of the single stock ETFs, because they can be hard to borrow at times, resulting in higher fees, and that can just be easier for individual investors. The benchmark asset, it can be effectively anything. Before I was saying the S&P 500, but it can be a commodity like gold or oil, cryptocurrencies like Bitcoin or Ethereum, or even single stocks like MicroStrategy, NVIDIA. The big tech ones, those big American stocks, are generally the ones with these single stock ETFs are focused on at this time, but I would not be surprised if they start to move down the market cap. Effectively, the leveraged ETF structure can be used against any asset, which asset managers love, since they can create a myriad of different ETFs to increase their assets under management and therefore their fees, which are not cheap. For leveraged ETFs, they are actually quite high. So you can look at SPY, one of the longest standing, if not the longest standing American ETF. For the US, it is actually the longest standing, but not globally, but I digress. So it has a fee of 0.09%. A 3x leveraged S&P 500 ETF, SPXL, is at 0.93%. So that's over 10 times the management expense compared to the standard SPY. There are some lower ETFs these days. FU, I think, is 0.03%, so even lower. But the leverage ETF is just adding on that fee. Or if you compare Bitcoin, IBIT, one of the most popular Bitcoin ETFs, 0.25% compared to BitX, a 2x Bitcoin ETF at 2.38%. Once again, nearly 10 times more. You do have like SOX and SOXO, which is about just under 3 times. But the point is, the fees are a lot higher. The trading costs are higher, but the management fund fees are also higher, and they get a bigger piece of the pie. So they love them. These asset creators just love them because they can advertise 50 different products in a very relatively simple solution for them and get their fees in. So the big structural drawback between, because I really was pumping up the benefits of them in that first slide, what is the downside compared to other leverage methods? Leverage ETFs, it's volatility, decay, or drag, and as well as path dependency nature of returns. I know it's shocking to some people on the internet, but stocks and broadly more financial assets don't just go up in a straight line. They can go down at times, even if they go up over the long term. They will go down during periods. And due to the general daily resetting nature of leverage ETFs, which the mass majority of them are, there's only a couple which are longer periods. Once you go into multi-period returns, they will not match the advertised leverage amount. To the fund's credit, they do normally disclose that quite up and center, very top first line type of thing, but it doesn't explain really why. They are getting a bit better at it, but it's still not to the depth which most people would need to really understand the problem with holding these over multiple periods. If it's meant to be a 2x ETF over a year, it is not going to be 2x. Sometimes it can be more, but most of the time the return will be much, much less. So we just use a simple example before getting into some real world returns. First, to look at volatility in pairs. We can look at a week of trading, 5 days, comparing two asset paths. So doesn't matter what the asset is in this case, because we're just examining the structure, starting at $10 with two very different degrees of volatility. Path 1, the asset goes up $1, then falls back down to $10 and repeats. And then path 2 does similar, but instead of going up $1, it goes up $2 and then falls back and repeats. At the end of day 5, path 1 ends up at $11 with a volatility of 10.5%, with path 2 ending at $12 with a volatility of 20.1%. That's something you'd expect in normal assets. Is the higher return is the higher volatility. There's your market efficiency. That is something which you would expect to happen in the real world. But you can't expect the levered ETF of path 2 to actually outperform. It's just not the case. Path 1 had a cumulative return of 16.2%, where the levered path 2 return only returned actually 2.4%, the worst return of all four in this table. So if you're comparing the two companies in this case, so path 1 is company 2 and path 1 is company 1. Company 2 was the better investment in general, but once you're layering that leveraged ETF to maximize return, which you might be directionally correct in this case, but you were so negatively impacted by the volatility, your end return was actually the worst option of the four. So you not only need to be directionally correct, but also overcome the volatility. The lower the volatility, the better for these leveraged ETFs. So if you have a straight linear return of the underlying asset, that's the best case scenario for these leveraged ETFs. That's just not a real world scenario in effectively any means or in any case. Further, I will note that the higher the leverage, the higher volatility, decay, or drag, that will impact the ETF returns. So a 3x ETF will be impacted more than a 2x ETF. In a similar manner, it just magnifies it even further. Next, we can look at the path dependency. In this example, we can once again start $10, and the assets both actually end at $11 over the 5 periods of trading. Path 1 increases or decreases by a relatively random amount. I just put these numbers in to make the volatility or the standard deviation the same. Whereas path 2, it goes straight from $10 to $11 and just stays flat after that. The volatilities of these assets or standard deviations are both 4.47% for both paths. So same volatility, we're eliminating the volatility, drag, or decay. If you just held the benchmark asset, the return is the same at 10%. But the 3x leverage ETFs are different. Path 2 rose by an expected 30% since the entire return happened in one day. Whereas path 1, with its random movements yet same volatility, only gained 29.36%. You might say that's only a minor 0.64% difference on a 30% return, but this is only a 1 week period. If we saw this recur again and again on a weekly time frame, it will compound over time, just creating a further drag on returns, completely irrelevant of the volatility. Now we can look at a real world example. Brennan's personal favorite, I believe, MicroStrategy, MSTR on the NASDAQ, and its 2x leverage, or one of the, I should say, just all the different asset creators are just diving into this one, and as well as other big American tech companies. 2x leverage companion MSTX. We can see on the 1 year time view, MSTX did actually perform at the start. When Bitcoin surged in November last year, we saw it actually outperform MSTR or MicroStrategy. But once that euphoria was gone, MSTX significantly underperformed. And that was really the asset during that time was relatively flat. But MSTX, just because of the volatility, decay, and path dependency, actually ended up losing 47%, roughly half, over this 1 year period, despite MicroStrategy returning a positive 59%. So you were directionally correct, but due to the volatility and path, a winning position actually turned into a losing position. And this is more common than not for these single stock leveraged ETFs. Despite being a strong market, most are actually underperforming the underlying stock and or similar returns over this last year when the spot checks ones, which I've done at least. And some you'll see they vastly outperformed for the first 6 months, but then the return came back down and they're actually mirroring return. And this has been a pretty good year, even though we did have, obviously, April was a poor month, but we're still up quite a bit through just broad market indexes throughout the year. And these, of course, can result in periods of outperformance. As you can see here with the MSTX, there was that November-December period, which was outperforming MSTR. But over the longer period you look at, the more likely it is going to be underperforming, as stocks just don't go up in a straight line. I know that hurts some people's opinions on the internet. Stocks don't just go up. So in summary, leveraged ETFs do have their place, but it's a trader's place. It's not an investor's place. They offer simplified leverage for short-term. Best use is intraday, so within a single trading period, as you don't get that volatility decay in any sense. They're just not suitable for long-term investors. You can cherry pick some better periods, but if we do see ever a flat market, even on a broad index, you will underperform, even with taking into consideration the 2x or the 3x return. Even if it's slightly up, it can underperform. You have higher management fees, which further increase the drag. That's straightforward. But then you also, of course, have the general risk with leverage, which I didn't go over here. Higher return volatility, increased losses, or chances of loss as they are magnified, just in general. And you'll see that regardless of what leverage products you're using. But further, you see that volatility decay. That is the biggest factor. Higher volatility will create a massive, massive drag on returns. So if you're thinking of using it for something like a hedge, you're buying an inverse ETF, a 3x inverse ETF to hedge your portfolio. That makes sense, right? But the problem is, once the broad stock market, we'll use that for example, an S&P 500 inverse leveraged ETF. Once that starts to go down, volatility increases. It's not going to go down in a straight line. It will go down 5%, go up 2%, go down 5%, up 4%, and so on. And that will actually just eat away any return you've even had, because volatility actually decreases or increases as the stock market generally decreases. You have those volatility clustering periods. So even in that hedging period, you can't just use this tool as a hedging tool really over the long term, only short term, very short term. Further, the path dependency, even though it's not the greatest trade compared to the volatility decay, it does actually matter, because even if you are even right on volatility, the path still does actually matter. It's just an added layer of complexity, which is why for probably 99% of investors, you should just not even consider these products, despite what the asset managers are continuously advertising to me, and I'm sure many of you. And that's where I'll close off. If you guys have any thoughts.
Yeah, I'd just say for further reading, to check out your article, which you just wrote on our website, on our blog. You go a little bit more in depth, just on leverage, and just kind of your examples as well. So, that is a good read for further reading. And again, just to emphasize, you said it, but these levered ETFs are they're tools for traders in the short term. They're not long-term investment vehicles. You can be right on the direction, but that volatility decay is going to eat up your returns. So you need to keep that in mind.
Yeah, I would say if on those single stock leveraged ETFs, the example was great on MicroStrategies. And I think if you asked most people, if you invested in a 2 to 3 times ETF on a single stock, and that stock was up 50% in a year, you definitely would think the average investor would probably say that you'd definitely be up in that investment on an annual basis. But shockingly, I mean, it isn't really shockingly, but I think to them, when you lay that out, you show them the chart on MicroStrategies. In most cases, the stock can, unless the stock went up in a straight line, which stocks don't go up like this, but in most cases, you don't beat the individual stock investment just in that company. You'd actually be down significantly. You can be losing significant money. Even again, Brennan, we keep saying this, you can be completely right. The stock is up 60% in a year, and I bought a leveraged ETF on it. I should be up 2 times that. Well, no, that's not the way it works. They're short-term vehicles, right? And I mean, they are advertised like that. They are stated like that. But I think when people look at, you get 2 times the S&P. Well, I would say most would think in a year, if the S&P is up 10%, I'm going to get 20%. And maybe they don't, but I've seen investors with far less complicated products not understand them. I would say there's likely a high degree of people that just don't understand, and just not understanding these products and what the potential downside. And I think it was laid out there well. And we're going to keep talking about that, because I know that many of our clients who even understand what investing in an individual stock is and the valuations, they don't understand these leveraged ETFs, generally speaking.
But yeah, like even looking at myself, back in university, 100% right, Ryan. Like just like what you said, it's like I thought that it would be, my return was going to be 2 times, the return on that asset, if I held it over the long term. Obviously, I've learned that over the years that that's not the case, but I think that's a very common
investor.
Exactly,
Like,
it's a very common misconception. Yeah.
I mean,
it's a marketing.
I'm not going to name any names. I was at dinner a while back, and there was some bunch of financial professionals there, and didn't understand at all what these were. So how can we understand? How can we expect the lay investor to understand these?
Yeah, no,
some will, for sure.
Especially when they're advertising the way they are. I'm seeing that more and more. Some of them are fine, which they'll actually say, but that keyword is always daily, and I don't think that will click for 99% of people unless you already know what it was. No, and I think that's the key thing, is they're covering their own asses, whoever the advertiser is, whatever fine creator, but it doesn't actually convey what the actual risk is, really.
No. All right. It was a good segment. I think that's going to close off our show for this week. Keep your questions coming into our Your Stock, Our Take segment. We will endeavor to answer those on a weekly basis. If you're watching this on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.